I'm Chris Preston,
And I'm Brad Simmerman.
and this is Street Check, the best podcast in the history of Cabot Wealth Network. I had our fact checkers look into that right before we went on air, and it's true. Brad, it has been almost exactly a year since ChatGPT launched and artificial intelligence became sort of in the mainstream. Where are you with artificial intelligence? How big a part of it is it in your life? Are you the robots are coming for us? I don't want any of it. Or are you artificial intelligence right now?
So the answer is yes, the robots are coming for us. But in regards to whether it has affected my daily life in any way whatsoever, no, I don't use it. My wife uses it periodically to write descriptions for creative products, and that's about it. What about you? I mean, we hear so much about it.
I mean, maybe in ways I don't know, but no, I don't. You know, I reject the notion of having a robot do write-ups for me on Tesla or
Yeah.
whatever. I know that's a thing that happens in the industry, but no, I've been lukewarm on it. Maybe I'll change over time. Everything new is scary first, but I've watched iRobot, I've watched AI. All those movies tell us that don't get too reliant on robots because they will turn on you. Maybe that's
Well, speaking of evidently useless technology, Chris, over the summer, you had a take to defend. You called Bitcoin over 40,000 before oil hit $100 a barrel.
Yes.
You're right. You nailed it. Bitcoin, as of today, trading around 44,000.
Wish we had a bell to ring now for
Bitcoin.
every right take. Yeah.
Yeah, we'll use it once or twice a year, and
Exactly. Yeah.
But
Rusted.
it's your turn this week to defend yet another take. And as I understand it, you're going to be doubling down. You have 90 seconds. Go.
Yeah, I'm doubling down. So let's see. Bitcoin right now is at 43,000. Let me get that up to date. Yeah, 43,874. So it's hit 40 and kept going. It's up very sharply in the last month, exactly. It was at 27,000. 2 months. 27,000 2 months ago, and now up to 43,000. I think when I recommended it over the summer, it was at 28,000. Oil was like the low 80s. Well, oil's down. Oil prices are down to like $70 a barrel now. We came close. Oil got close to $100 a barrel before retreating. At the same time, Bitcoin's gone up. Well, the pattern with Bitcoin is that once it goes up, it really goes up. And usually it's in tandem with the market. So it would be another 50% for it to break its record highs of 65,000 from November 2021. I think that's where we're going. I think we're going to flirt with that. Here's what I think. I think it'll get above new record, 65,000, before oil hits $100 a barrel. It would be about 43% for oil prices to get to $100 a barrel, and that's a much bigger leap for oil prices than 50% for Bitcoin.
Yeah, when it runs, it runs.
Down. Yeah,
I think that's a reasonable assessment. Certainly. I mean, you've written before about how Bitcoin's probably not something you want just to park in your portfolio, but if you can get on it at the right times, it's going to generate some incredible returns for you.
Yeah, it's a bull market play, I think, right?
Yeah.
Every time stocks go up, I mean, so the huge run up, when it hit 65,000 before started in, not coincidentally, spring of 2020. Or I guess it was more like late 2020 when it really took off as the market was taking off. It bottomed at Bitcoin prices were at 5,000 in March 2020, and by March 2021, it was up to 60,000. Now, I don't think on a percentage basis, it's not going to be that big a gain, but
not going to 10x again. You're hedging your bets on that one.
No, but from 28,000 to 28,000 to new records. So, basically more than doubling is pretty reasonable, as long as the market doesn't collapse, which I don't think it will. But we're going to talk more about that with our guest for today. We're scrapping our usual big three topics. We sort of rehashing what we discussed last week, but we did want to piggyback a bit on what we talked about last week, which was small caps. Well, today we invited on our Cabot's resident small cap expert, Tyler Laundon, who's chief analyst of our Cabot Small Cap Confidential and Cabot Early Opportunities newsletters. Tyler, welcome. Tyler, what do you think about my Bitcoin take?
Well, nice to see you guys. Chris, Jacob actually just wrote an article on our website.
That's right. Yes.
Yeah. So I have
you were
not
pro Bitcoin or anti Bitcoin? I can't remember.
I'm not really anti, to be honest. I'm just sort of like, there's so many other options, when you're looking for small caps and micro caps and everything and super high growth stuff, then it's just like it can be an overwhelming, area to put money to work. And as I said to Jacob, I think this was like a year ago, I have plenty of opportunities where I could blow up a position without having to speculate on cryptocurrencies. Although, obviously Bitcoin has kind of proven itself out, I guess, over the last year, and it's just done so well that it's kind of hard to ignore, I guess. But I'm not a bull or a bear. I just have too many other options with stocks that, have like businesses that I'm interested in.
Yeah, I'm not a Bitcoin bear either, to be clear. I think it's fleeting, but once it, it's like a roller coaster. Once it gets going downhill, it picks up steam, but then, there'll be an uphill again, and it'll really start to decline. But Brad, you're about to say something.
Yeah, I think Bruce would have a significant problem with this conversation, despite being sort of a gold bull. I mean, Bitcoin is like gold in that it doesn't pay you a yield to hold it. It doesn't. I mean, gold at least has like industrial uses. Bitcoin right now doesn't actually really do anything. One thing Jacob had me add to his article that ran today was some commentary from Jamie Dimon, the CEO of JP Morgan, saying that all Bitcoin is good for is criminal activity, tax evasion, and speculation, which thus far is true. Now, I'm probably more bullish on cryptocurrency as a concept or as an asset class than you guys, in that I can sort of envision some future cases for it. But right now it's purely a speculative play, but it's had a heck of a ride this year.
Yeah, I think I'll jump in with one comment, Brett. I think you and I talked about this some months ago. In a way, Bitcoin it's kind of like a software play, right? It's like a technology play, whether you want to think of it as a cryptocurrency or like as a currency or an alternative like fintech play or whatever. I kind of put it in that bucket of opportunities, I guess. Granted, with a much larger market cap and larger following than any individual, smaller mid cap fintech play.
Yeah, and Tyler, so Bitcoin was my hot take today. Last week, Brad had one on small cap stocks, your wheelhouse, obviously. Brad, what was the wording of it? You said it'll be up, small caps will be up double digits next year, even without a catalyst. Is that right?
Yeah, that's largely right. My specific premise is that the mega cap tech stocks, just on a valuation basis, are overvalued in the neighborhood of like $3 to $5 trillion. Going back to like 2015, they've sort of decoupled from the broader markets. They're 30% of the S&P 500, despite being only 20% of the earnings and revenues, or 20% of the revenues, and I think like 10% of the earnings, both of which have doubled since 2015, but the market cap weights have tripled. So even if you just had big institutional investors reallocating proportionately, you're talking about, in the neighborhood of $250 billion getting allocated to small caps as an asset class, which is about 10% of the market cap of the Russell 2000, which tells me you've got potential for double-digit returns absent any kind of major catalyst, just in sort of a business as usual environment. I am curious what your thoughts are on those valuations, et cetera.
I think that's interesting, the way you broke it down like that. I guess I kind of like step back and look at it like big picture. So we've seen, if we go back like decades, small caps do tend to outperform. But there's always examples, right? Like they've done horrible over the last 2 years, 3 years. So this year, though, they're up 5.8% versus large caps are up about 20%. So that performance differential is continuing. I think that small caps, it's just such a different index than the large cap index. Like Brad, you just referenced the weight of the mega caps at like 30%. So in the small cap, like the S&P 600, it's like 18% financials.
Yeah.
Right. So that's just like, it's just structurally such a different index than the large caps that it's kind of like comparing apples to oranges, right? It's just a different thing.
Don't you use the S&P 600 as your go-to sort of barometer or index?
Yeah, I do, for a couple of reasons. It's a bit of a higher quality index, like the earnings are better, and also it's easier for me to get like earnings estimates for the S&P 600 than the Russell. So it's just an easier index for me to analyze. But Brad, back to like this question of what could small caps do. So they're trading at a discount right now on valuation as well, like a pretty significant discount. And with this heavy financial component, and roughly 40% of small caps are on variable interest rate loan lending structures. So the huge like increase in rates over the last 2 years has kind of decimated a large portion of the index, like the financials and the industrials, the sort of the debt heavy companies. So again, like if you get down into the weeds of it, there's been all these headwinds that finally, with the Fed kind of poised to pull back a little bit, can like release some of this downward pressure. And I think we could be in for a pretty good stretch, whether it's a year or 2 years or 3 years or 5 years, who knows? But I think that I would say like over the next 16 months to even 5 years, I think small caps is a pretty good place to be. I would think that it could outperform certainly like the market weighted large cap index.
Yeah, I think you've cited, Tyler, that small caps outperform large caps through their history every 3 out of every 5 years, and they've underperformed for is it the last 2 years now, maybe even more?
Yeah, it's like 2 going on 3.
Yeah. So they're due, as they say. Not that necessarily means anything, but there are other reasons for that, and why I think we, have been pretty bullish on them going forward. Are there sectors that are really standing out to you right now as sort of perking up, or you think have the most potential in the next year or less?
Well, I think it's interesting. Like, so we were just talking about, at an index level, and then obviously you can break that down to sector level. So healthcare, industrials, whatever. But I kind of tend to focus on like medical technology stocks, which would fall into the healthcare bucket, and then software stocks, because those over time have, in my opinion, shown like the greatest potential to kind of grow out of the small cap index and become, mid caps and large caps. So some of that isn't really like captured in trying to pick a small cap sector. You might be better off with, in my opinion, like a cloud ETF, like CLOU or WCLD, and those you can kind of break down and look at what's in there, and you would get a decent amount of small cap cloud software exposure, whereas you can't really get that by buying like a small cap sector ETF. So those couple ideas there. I do think that healthcare in small cap has been pretty decimated. It's down 13% this year versus 3% for large caps, and a lot of medical technology stocks are in that basket. So that could be a bit of a recovery play that it's not nearly as stretched as some of the other areas of the market.
Now, one thing that, going back to, you'd mentioned 40% being on variable rates. Do you have any sense of what number of small cap companies are essentially white knuckling it and just riding these higher short-term rates, hoping for the rate environment to improve, versus how many are maybe repositioning their lending options or their own balance sheets to or how many are banking on rates coming down in the next couple of years versus how many are approaching the interest rate environment as if we're going to have persistent higher rates. Do you have any sense of that at all?
I don't know. I haven't done that kind of work. I think that gets pretty granular. I do,
Yeah.
you know, with the companies that I follow kind of closely that we are having in one of our portfolios, and those that I'm just watching, I'm paying attention to, like, you know, when their debt maturities are and when they can kick it out. And the thing is that with the types of stocks that we at Cat, like the small caps that I tend to cover, a lot of them aren't going to be like your debt heavy energy or industrial stock. They might, if they need money, they might do like a convertible debt offering, or, you know, an equity raise. So we're talking about small caps as like an asset class and like at the index level, but in our portfolios, the ones that I manage, it's really sort of the higher growth stuff that stays away from a lot of that area that's been just under so much pressure the last couple of years because of the interest rates, like on a debt level.
Mm-hmm.
Yeah, and Tyler, you know, I mentioned you run both Small Cap Confidential and Cabot Early Opportunities, and that, or the differentiator is that Early Opportunities isn't just limited to small caps. You know, for example, you identified Microsoft early on, you know, maybe close to a year ago, not long after the Chat GPT launch, said, hey, this is going to be big. Microsoft, you know, is at least on the surface is as far from an early opportunity as you can get. But you've been right. You know, Microsoft's up more than 50% in the last year. Are there sort of large opportunities out there that, at least sectors that you're seeing, that, you know, are sort of similar to small caps, and that they're sort of due for a bump or have some sort of catalyst that's going to drive them, you know, in the coming months?
Yeah, I think it was interesting, Brett. Like, you guys were talking earlier about the weight of the mega caps in the large cap index, and like the pros and cons of that. I think that, just going back to Microsoft, Chris, like, it's some of these mega caps are like their own global economies now, right? Like, they're so important to what we all do that they're just like, they're in their own class of stock of a company and of a stock. And I think with Microsoft, what they were doing with AI is like what they were doing when they converted to the cloud, like years ago. Like we covered that, you know, years and years ago. I think like those types of big picture moves, that they just kind of snowball over time, and they can lead to really significant gains in some of these big companies. Seeing something like that in a stock like Rivian, for example, like that, I think that's a potential opportunity. It's, that company just has like a fantastic product, and they're doing something that's just so different from what a lot of other auto manufacturers and EV manufacturers are doing. And if you kind of get into the weeds of what they're doing, then they're like laying the groundwork for higher sales, lower costs, all these kind of interesting business operation things that could drive like significant long-term growth. And that, you know, it doesn't necessarily seem like an early opportunity because it's a relatively big company. But when you look at what they're doing on a business level, it's kind of hard to not think that a stock like Rivian could do very well if management, you know, executes on their plan. That's not really a sector play, but, you know, that's kind of the types of opportunities that I'm looking for in that newsletter. Yeah,
no, it's funny you mentioned Rivian. You know, you say it's not a sector play, but, you know, one of the ones I'm highest on, you know, and I've been recommending in Stock of the Week and mentioned on here ad nauseum, BYD, for similar reasons. Just they sort of have the China baggage, which has held them back, whereas Rivian doesn't have that, which And just anecdotally, at least here in Vermont, Rivians went from being, you knew like the one person in your sort of stratosphere who owned a Rivian or ordered a Rivian, and now suddenly you see, at least I see one like once a day on the road.
Yeah, it's crazy. We've been skiing at Stowe a couple of times this year already, and it's like 5 Rivians every time we go to the mountain. And
right.
I mean, we're not seeing that here in Rhode Island at all. I don't like, Brad, are you seeing those cars on the streets in Arizona at all?
I clocked one a couple of weeks ago, but like other than the 2-mile drive to my gym, I don't leave the house much or going to the grocery store. So I'm not exactly on the highways taking a census of who's driving what. I mean, it's like, I will say that just anecdotally, it does feel like Tesla maybe 4 years ago, where it's of note. They look pretty cool, and I think people are just broadly not familiar with the offerings. I mean, you mentioned going skiing with them, and my first question is, oh, do they have a really good SUV? Is that like a product differentiator for them? I don't know. So
that's their main thing, right?
Yeah, it's a truck and an SUV, and their towing capacity is like just insane. It's not that much bigger than a mid-sized SUV, but it can. I'm probably misquoting, but it can tow like 10,000 pounds, which is, if you're into towing things, like that's a pretty big differentiator versus like a mid-sized SUV, a gas-powered one.
Yeah, my wife's like mid-sized Jeep 4-wheel drive is like 5,000 rated. I think the F-150 Lightning is sub 10,000 pounds, if I recall correctly. I think you're getting up into like the F-250, F-350 territory once you get over that 10, 12, 15.
Yeah, and you can potentially beat a Porsche at the red light on like 60-mile sprint
and leave your boat behind you.
Yeah, right.
So Tyler, just so let's looking at the market as a whole, obviously coming off a great November on the heels of a rough 3-month stretch. Now, things are sort of flattened out a bit. Although small caps have outperformed large caps since the start of November. I think they're up. The Russell at least is up 13.5%, maybe even better in S&P 600, 13.5% since the start of November versus 9.5% for the large caps. Where do you think just the market as a whole goes from here? Do you think small caps will continue to outperform for months? And A, and B, do you think the rally in the market as a whole will stall, or do you think we're headed higher?
Well, as we all kind of talk about, like
crystal ball,
yeah,
mine's broken as well.
Yes,
but obviously it's interesting to speculate as to what could happen. I think that, so much comes back to what the Fed does or doesn't do and like says, and, we're all kind of so sick of just everything depends on the Fed, right?
I know.
But I think we're still there. So we'll know more next week when that next Fed meeting wraps up and what they have to say, and the market's going to take that and project out into 2024 what interest rates will do. And I think that's gonna, I think that people might be getting a little bit ahead of themselves and thinking that the Fed is going to cut 3 or 4 times by next summer.
I don't see that. Yeah,
I don't. But a lot of, again, like some of that is like headline driven. Like if you actually look at what the probabilities are, I have them up here right in front of me. So theoretically, like 40% chance that there will be 3 cuts by the end of July, right? So like these headlines that say rate, Fed is set to cut 100 basis points by like the end of July or end of August. You have to kind of look at what the actual probabilities are for each rate cut for each Fed meeting. So it's kind of a personal pet peeve on trying to digest headlines. But I do think
if it's more than 1 by next July. But
there's rate cuts like, hey, the economy is fine. We can ease a little bit, and like that's a rate cut 25, 50 basis points, maybe by like May. And then there's rate cuts like, oh, we're in trouble. Like we have to really slash rates before we crush this economy. And that's a whole different scenario. So it's like there's rate cuts and then there's like capital rate cuts, right?
Yep.
So I think those are two different scenarios. I think that the Fed has done, for all that we complain and have done, talked about how the Fed is screwing things up over the last like 18 months or whatever, they have threaded the needle amazingly well. Partially they've been bailed out, I think, because consumers continue to spend. But I think the bottom line is when you step back, I think that this like kind of like bumbling along through without anything too serious breaking trend is what we will have through 2024. And that's not like, it's hard to write a headline around that, but I think that's just what we've been dealing with. And I think that's what we're going to continue to deal with. And I would expect they would cut 50 basis points by May or June. And that should help like the broad market hold up relatively well. But I think that small caps, because of all those reasons we talked about earlier, they traded a discount. They will have outsized benefit from rate cuts, assuming that they're not, like all caps rate cuts.
Yeah.
And like kind of the relative performance that they need to make up to stay on trend with their long-term outperformance. I think all those things point to broad market holds up okay, small caps outperform. Fed is able to cut a few times by mid 2024 without destroying the economy. That's kind of like my big picture thinking on it. I don't know if that aligns with what you guys are thinking, but
So I want to go to, speaking of headlines, came across one indicating or saying that, the Russell had gone from oversold to overbought conditions in 24 trading days at the, in November, right? So my take on it, or my takeaway on it, is they're just using RSI or something like that. But I went back and looked through the last 5 years. There were 3 instances in which it previously went from oversold to overbought conditions in a sort of similar timeline. One was immediately after the December of 18 sell-off at the beginning of 2019, which led to about a 10% run up in small caps. Again, after the March correction, the March of 2020 correction with the pandemic crash, quickly rebounded. And then it sort of got there in April of 2022, which was sort of a false start rally. My sense on it is probably not particularly useful insofar as, yeah, it could have gotten overbought really quickly because it's in actually a meaningful uptrend, or we could see another false start rally and then we just sort of move laterally. Of those two sort of outcomes, with small caps being a little bit overbought right now, which would you? I don't want you to give a percentage chance, but are you thinking that we're seeing the beginning of a meaningful rally, or do you think that we've still got some more work to do?
I think that I have the Russell 2000 ETF, the IWM, up in front of me just because it's easier to look at, and so overhead resistance from the last, I guess, year and a half is like right around 200, and we're at 185 right now. Support has been like in the 163, 160, 168 range, and we're kind of like, right in the middle of that. I think that short-term overbought can be concerning in the short term, but I don't think I would let that keep me out of trying to make a longer term play on an asset class that I really believed in. So I'm kind of inclined to think that time can take care of those overbought conditions, right? Like a few weeks, a month perhaps.
A trend will be overbought for as long as it remains sort of trending, or oversold if it's a downtrend. That's sort of the nature of trends. So maybe a takeaway is, if you're concerned about short-term volatility, maybe look for a breakout over some technical levels in lieu of piling in immediately. Look for some confirmation of the continued outperformance, maybe.
Yeah, give it. I mean, again, we're talking about the small caps as an asset class, but really what we're in our newsletters, what we're doing is we're buying individual stocks,
Yes.
which, so we don't get into the weeds of small cap ETF big plays, right? And like when exactly to buy those. I think a lot of investors that probably read our stuff are maybe doing that in an IRA. Like when does it make sense to allocate to small caps? And I think that's the way I look at it, and I think that's where we are now.
Yeah.
So
you mentioned our newsletters. I touched on yours earlier, but I wanted to mention again for listeners who aren't familiar that you run Cabot Small Cap Confidential and Cabot Early Opportunities. As I said, if interested, you can go to the cabotwealth.com website under Premium Advisories page to subscribe to either. With the small cap, both, but Early Opportunities is newer. Small Cap Confidential in particular, I know vastly outperforms not only the index, but small caps as a whole when times are good. I know you had a couple of years ago, I think you had an average return of over 200% when the market was really humming. Are you seeing that kind of upturn in your own stocks right now after the month plus that small caps have had?
Yeah, well, I'd love to get back to those types of returns when
no one has those right now.
But yeah, I mean, we've had a pretty decent stretch over the last 2 months, put it that way. I mean, there's not like everything is working, but definitely things have picked up, and it's been kind of interesting. Like during the August, September, early October timeframe, I mean, there was some serious pullbacks in a lot of stocks. I don't know if you guys remember that, but like some stocks would report and be down 20 or 30%, right?
Some of them after beating earnings.
It was totally. It was one of those crazy times, and so being able to take action on some of those stocks has certainly helped. But yeah, I think that the rising tide out there is certainly lifting a lot of our stocks. So hopefully that can continue.
Amen. Brad, any last questions for Tyler before we let him go?
Yeah. So one thing that you have written about periodically is, seeing the AI story play out actually for companies generating real results. Chris and I opened the episode talking about whether we use AI in our daily lives. Are you actually utilizing all these promising tools that were much hyped a year ago and maybe not so much anymore? I don't know.
I think that, well, yes. You guys had some interesting comments on like writing content. Like Chris, you were like, I'm not gonna, ask ChatGPT to write up a Tesla story on me and then put that out there. I think the problem with that is, like, you guys, like our readers and listeners, they want to hear what we have to say on stuff, not like a regurgitation of what's out there publicly available.
Right.
So having said that, I think I have tried using like ChatGPT every now and then to summarize some content, that like an earnings report or something like that, just to save time. But it feels like cheating to send that out and not add your own flavor to it. Where I'm using it more is in solutions that help aggregate and break down data and earnings transcripts and things like that, to get transcript summaries, like from an earnings call that might take you 45 minutes or an hour to listen to, a little bit less time to read, but I can get those transcript summary notes using AI. But that's not like a publicly available AI solution. That's used in a paid for software product. And I think that's where the companies that I'm following are using it in those types of solutions. So they're taking data that's not publicly available, that's proprietary, owned by whatever organization or partners, And then that data is being analyzed and used to generate content and inform decision making. And I think that's where the value of that is. And I think that's where it's going to continue to be.
Yeah, that echoes something that I've heard mentioned a couple of times on another podcast, Plain English. Chris, you and I have talked about this before, where it's like the good use of AI right now is it's a well-meaning research assistant more than it is a portfolio manager or an editor or any of those other things. So that I'm very, very appreciative of you sharing that. That somewhat validates a lot of what I've heard elsewhere.
Yeah, hopefully we won't have AI in our chairs in about 6 months. Hal, C3PO, and R2D2 in our spots. But it is obviously makes for a good investment right now. And I know that you're still pretty heavy on AI in your portfolios, right, Tyler?
Yeah, I think it's just like this next generation of software tools that is helping with productivity and helping us all do more, better, more quickly, all that kind of stuff. And it's helping companies create new products and create new revenue streams without necessarily needing to hire a lot more people and do some upscaling and all that. So I think that there's a whole bunch there, as you guys know. So I think it's another pretty significant trend that's going to be with us. It's just like cloud software 3.0 or 4.0, however you want to look at it.
Yep.
Yeah, and that's another good example. I mean, most users, the average computer user, the average software user isn't thinking about the amount of cloud activity that's taking place, the amount of pulls from data clouds all over. You look at your application, you look at your phone, you look at your computer, it works or it doesn't work, and it's operating in the background, but it's significant and it's meaningful for the companies that are doing it. And I think that's a reasonable sort of direction or pathway for AI and increased AI integration to follow as well.
Yeah. And, just to wrap it up and kind of tie it up to what you guys were talking about at the beginning, behind all of that stuff is either Amazon, Google, or Microsoft.
There's a reason all these companies have done so well. Rooting against them is, like rooting against, Coke or Pepsi or, I don't know, the Yankees.
I mean, who then what was it? Random walk down Wall Street. The takeaway is like, just buy the market, the S&P 500. If you own any index fund with 30% of those, if you own the S&P 500 index fund, you better be a fan of Microsoft, Amazon, Apple. If you're not, you should be buying a market weight ETF.
Right. Yeah. Rarely have there been better years to just buy that ETF, unless you bought those magnificent 7 stocks, but costs a lot less to buy the index. Well, I mean, it seems like momentum is there for things to flip, or at least for small caps to play catch up, which they are now. And I think it seems like there'll be good times ahead for that sector and for you in the coming year. And hopefully that's what you're feeling. Yeah. Well, Tyler, thanks for joining us. And as always, if you haven't already, please subscribe, give us a 5-star rating, or if you have any questions, email us at streetcheck@cabotwealth.com. Again, Tyler, thanks, and we will talk to you next week.
Thanks for having me, guys. Have a good weekend.
Too.